Hi everyone, and thank you very much for watching this video. We're here to give you a monthly market update with Akhil from our mortgage broker. Thank you for joining us, Akhil.
Thanks, Tristan.
We thought it'd be a good opportunity to fill you in each month and talk about what's going on with the mortgage world, how it can impact you, and also how it can benefit you as well. So let's go straight into it, Akhil. Let's talk about residential and buy-to-let. Obviously, you're dealing with it both day to day, but just in a small overview, what's going on?
Well, where do I start? There's lots going on in our market, like yours as well. It's an ever-changing barometer at the moment. But what I would say is residential, first and foremost, you've got to keep an eye on interest rates. Bank of England have increased their rates over the last few months. We're now at 1% at the Bank of England base rate. And what that means for homeowners, mortgage owners and the alike is you've got to be conscious of when your mortgage rates come to an end and a plan ahead so you can then benefit from the new fixed rates sooner rather than later. The benefit of securing the new fixed rate will simply mean that you're committed to that new loan for the next 24 months or 60 months, and you won't have any issues with any changes in the market. If, for example, you land on the standard variable rate, you forget about it, or you're too late to make a decision, you will be, well, if you like, penalised because you then land on the standard variable rate of the bank, which usually means your mortgage payments can double. It can double overnight. So the key here is keep an eye on when your fixed rate mortgages are coming up. The best time to contact us is up to 6 months prior to your mortgages coming up. And that's for both residential mortgages and buy-to-let. So both mean exactly the same. But from an interest rate perspective, lots of talk in the market. The next update's obviously in June, mid-June or so. So be conscious of rate changes. But the key here is contact your mortgage brokers sooner rather than later, whether you are a homeowner occupier or a buy-to-let portfolio landlord as well.
Perfect. So you briefly touched on it in terms of the next review being in June, but in terms of what's happening today, starting with a personal buy-to-let mortgage and then moving on to a limited company, we know obviously there's a slight difference in rates, but if we go back to December last year, you were seeing rates as low as 0.79% for a buy-to-let mortgage. We're not seeing that now. We are obviously starting to see the gradual increase. And as me, Mike and Ian say quite regularly, today is going to be the cheapest day you'll buy a property with prices being as high as they are, mortgage rates being as low as they are. Are they going up, going down? Are they maintaining? What's going on with that? And what's the sort of headline rate that you're seeing at the moment? Right.
So from a residential point of view, the rates are determined by the Bank of England base rates, quite simply. Rates are going up. We get as mortgage brokers, we get updates prior to any rate changes, and the reason why we get them is just so we can get the application submitted with any particular lender sooner, so we can capture and secure that rate for our clients. But in essence, rates are certainly going upwards, and they've been meaning to do so for the last couple of years. Inflation's playing a big impact on the residential mortgage rates, and that's going to happen for the foreseeable future. So yes, do secure those rates sooner rather than later. With regards to the buy-to-let mortgage rates, they're actually coming down. And in particular, it's the limited company rate. So for your listeners out there, your viewers that are looking to acquire buy-to-lets in SPVs, which is a special purpose vehicle for the sole purpose of owning residential property, those rates are actually coming down to what they were 12 to 18 months ago. And the simple reason is because the lenders in that space don't track the Bank of England. They're usually funded by hedge funds, private investors and other institutions. So they are in the competing space with their peers on that level. So what we're seeing is rates certainly coming down in the limited company space, but from time to time, we do have rate increases. But just to give you guys a bit of a snapshot of where rates are from a buy-to-let perspective, in a personal name, they're starting at roughly about 2% in the personal name, which is at 75% loan to value. And then in the limited company SPV space, you're looking at about 2.6, 2.7%. So there's a marginal difference in the rate between personal and company formation. But again, speak to your property tax accountants whether the limited company route is better for you or a personal name application to be done for you. But again, we'll compare apples and apples and provide you with both sets of rates and terms for you to consider and compare.
Still very competitive, 0.6% between the two. I think it depends on, like you said, sit down and work out the plan of action.
I agree.
It just goes back to the, we've had a few podcasts recently, but one of them was work out your goal from day one, plan backwards. So if your plan is to invest in multiple properties and you don't plan to extract money, maybe the limited company space might be the better option for you.
Yeah.
Whereas if you're looking to extract the money, it might be slightly different. So
you definitely hit a nail on the head there. I think you've just got to be conscious of the double taxation. If you, as you quite rightly said, Tristan, if you do take money out of the company, you want to get corporation tax, and then you've got income tax to tackle as well. So we're not tax accountants, but what we want to do is just make sure we refer you to our power team. And it's key in today's business, as serial property entrepreneurs, that we have the right power team around us to guide us and provide us with the right information, because it's an ever-changing world at the moment. And I always say every day is a school day in our business, and you can never know too much. So I think the key here is if you are in property, if you haven't taken it seriously yet, you must do so, just simply because legislation is so it's an ever evolving tool at the moment, and you've just got to be conscious of the market changes as well. So we've got house prices, they're still very, very high. We've got supply and demand issues. We've got inflation issues. We've got rates on the up now as well. So I still think, I think buy-to-let is certainly not dead. And we see that just quite simply by how busy we are as a brokerage. But I think the key here is do your due diligence, speak to the right people around you, estate agents, tax accountants, and the likes of us as brokers, because finance is the key. 90%, 99% of the clients, need funding to acquire the property. So understanding, what the long-term goal is, as you rightly said, work back to front. And if it's a yield play, if you're after yield, let's have that conversation. If you're after capital growth, then you want to invest in, London and the home counties where the yields might be, sub 5%. Which might sound not as good as further up north, or some might say that's fine by them. But let's have that conversation. And we're not just mortgage brokers, we're not just order takers. We're here to build relationships with our clients and provide that that key information, because as I said, every day is a school day.
So I don't know if you're seeing the same, but I'm specifically dealing with a lot of trades. A lot of people, they've been very busy during COVID, and they've had additional funds that's gone into obviously their limited company.
Yep.
And it's like, what do I do with the money? So a lot of them have been looking down the avenue of investing in property, which is an obvious reason. But what are you seeing from an intercompany loan? Are you seeing much of that yourself, and what are the benefits of doing so?
So it's a great question. So for those of you that don't know, an intercompany loan is simply, we've got you as a self-employed business own a trading company. Let's say you're a builder's merchant. You've got a whole load of cash sitting in your business account, and you've never needed to take it out. But you also own an SPV for the sole purpose of investing into real estate property. What the two companies can do is your trading company, the builder's merchant, can transfer those funds to the SPV for you to acquire those properties. So it's an intercompany loan. And lenders accept that as proof of deposit audit basis. Again, the trading business owner, directors and shareholders need to be aligned. They need to take up the relevant tax advice. But the beauty here is you can extract funds out of your trading business, put it into an SPV, and I'm sure that there must be some benefits around tax from that perspective. But again, speak to your accountant. But it's good to see that the market is there's so many options out there, and we actually sport for choice in the lender space, in the buy-to-let, whether it's bridging, whether it's buy-to-let, whether it's homeowner mortgages as well. So we are sport for choice, but it's good to see lenders are lending at high loan to value. So in the buy-to-let space, up to 85%. In your residential homeowner spaces, up to 95%. There's a lot of chat at the moment around income multiples. I think we'll touch on that question shortly as well. But the good thing here is that there's plenty of options out there. If you think it can't happen, it might not happen, but you won't know until you speak to a brokerage that's independent and experienced like our mortgage broker.
And then moving on to green deals then.
Yeah.
We've spoke about it previously, EPC changes, pretty much likely to happen in 2025 with everything that's been going on, Queen's speech as well, and pushing things forwards. But what are you seeing from the mortgage world? Are you seeing more and more products coming to market, a lot more competitive?
Yeah.
Is there going to be any other changes we need to be aware of? Can you share some light on that?
Yeah, so the biggest topic at the moment is the EPC changes that are potentially coming into effect from 2025. So for your viewers out there that may not know about it, potentially there could be any buy-to-let properties that need mortgages will need to have an EPC rating of between A and C to get a mortgage. For any new tenancies, any existing tenancies need to have an ATC from 2028. Now, it's still under consultation, but there's a lot of noise about that space. But what lenders do, lenders adapt when they hear a lot of noise. So it's quite open knowledge that this is coming into effect. Whether it's going to be A to C, at the moment they're saying that, it might well be A to D. But what you should be taking away from this is if you own properties that have a D or E rating and they are mortgaged, you've now got to start, you've got to throw a 3-year window where you need to now start thinking about where you can add value to the property and improve the efficiency of your property, because you might have an issue raising a mortgage in 2025. That's the key there is, and for those people that are looking for investment properties, look for properties that have an A to C EPC rating, and there's two main benefits. One benefit is the greener deals, the greener products, what lenders are calling them at the moment, and you benefit from preferential rates. So rather than, for example, 2.99, you might get 2.79. So having a property that's rated A to C, you will benefit by a small margin. But if you own a large portfolio, every little helps, as they say.
No, definitely. And then I think the tip from me would say is, don't wait until 2025 when it's last minute. But the reason for there's going to be a lot of people in the same boat. And if that change does come into effect, imagine if you've got thousands of people wanting to upgrade their property. Contractors are going to be so busy, inundated in work. What's going to happen to their prices? They're going to shoot up as well. So you're going to pay a lot more to get the work done, first of all. So get it over and done with. Be prepared. I mean, the likelihood is it is going to happen. Whether it is 2025, we don't know, but I think it's looking very likely, in my opinion.
Yeah, I agree. And I think just again, speak to the relevant power teams around you in that space, how to improve your efficiency. It might well just be light bulbs, but it might be, grander things like windows and boilers and insulation. So, see where you can get quick wins. The EPC is certificate is valid for 5 years.
10 years.
10 years, sorry. So start now and it's valid for 10 years. So that's a great way of thinking of doing it. But as you said, tackle it now, because now's the right time to do it.
Especially with rates being so low, if they're refinancing and whatnot, it's a good opportunity to take some of that money out and start the work on that, because we are looking at quite a high increase to bring it up to those standards on a typical property that's below a D. To do that. Base rate's gone up to 1% that we spoke about. Cost of living is pretty much an all-time high. We're seeing everything going up in price. What are the lenders doing from that side? Are we seeing any concerns from their side? Would they be pulling products if that was a concern? Are they getting stricter when they're doing their checks? So what's going on from that we need to be aware of?
Okay, so let's get buy-to-let out of the way first. So from a buy-to-let perspective, the cost of living doesn't have any bearing effect on that. Buy-to-let lenders are concerned about today's valuation, the rental income that the property is going to produce, and the state of the property. Is it mortgageable and habitable? So the affordability doesn't really play into effect for buy-to-let mortgages. They're more concerned about the property, your experience, and income that you've got in the background, general income, for their own criteria. Now, the affordability checks are heavily weighted on the residential side, i.e. homeowner mortgages for where we live. Now, as you quite rightly said, inflation is at an all-time high. The cost of living is certainly on the upwards, and we don't know when it's going to end. Is inflation 10% or is it 20%? Who knows? But what you can, bet your bottom dollar on is interest rates will keep going up to try to combat inflation. When it fades out, we don't know. There's lots going on, and it's there's wars going on and all sorts at the moment. So we can't do as much as we can to shorten the burden, I should say. But what I would say is what you can do is make sure you are reviewing those rates and speaking to brokers like ourselves to make sure that you're in the right deal, because the deal that you were in 5 years ago you might be well better off now looking to refinance it now because rates have come down so much. So do that. With regards to the affordability assessments, now lenders have always assessed mortgages dependent on your income and your outgoing expenses. So if you've got car loans, large credit card balances, personal loans, they will have a detrimental effect on how much you can borrow against your income. So they do have a debt to income ratio, they have an income multiplier, they also have an internal calculator which then sets out using the ONS data out there to say, husband and wife, 2 children, the cost of living is X. They'll play that into account and they've got their own affordability. Now the key here is that the beauty is every lender's got their own internal assessment calculators. And as mortgage brokers, that's the other benefit that we have, is we know what the lender's appetite is. So whether you are a first-time buyer or you're a high income earner, i.e. 6 figures or more, some lenders are a bit more lenient. The other key factors is what part of the country you're buying a property in, because some lenders will lend more in certain regions of the country. What does your credit score look like? Credit score is key around the affordability, how relaxed they are. And then the other one is the loan to value. The more you borrow, the less that they're going to borrow, because the risk is a bit more higher. So the higher the borrowing, the more due diligence, and usually the lower affordability that comes out of that. So there's lots of weird and wacky ways of putting it all together, but that's our problem. And I always tell the clients that, you know, the finance is our problem. Your main concern is to find the right property or provide us the information you require. The first deal we always do with our clients is always the most onerous, because we don't hold any data for the clients. But we know what we're doing. We've got access to a wide range of lenders. And that's the beauty about today's market, because the rates from the high street and to lenders that are off the high street are not too dissimilar whatsoever. And a lot of lenders in our space now are only intermediary led only, so you can't go direct to quite a few lenders. So I would certainly recommend your viewers and listeners to contact mortgage brokers from that perspective. But I think there is a few concerns coming out at the moment, and it's around valuations. So everyone thinks their property's worth X, yeah, everyone does. But what you've got to be conscious of is the surveyors that go out on behalf of the banks to go and value that property, they go out with a different mindset. I always say they're a bit more conscious or cautious around the market and the trends. And there's a lot of noise of we're going to have a recession tomorrow, but everyone thought that in, you know, the first lockdown in 2020. But what happened? It went totally the other way. So it's one of those that you just don't know what's going to happen. But you've got to be conscious of, if you think your house is worth £1 million, have you got genuine recent comparables of what's been bought and sold within that area in a small radius, and like for like similar properties? So if you haven't got real comparables, you may have a problem. But again, do your due diligence, and we speak to our clients and we provide that due diligence as well using our back office systems. So I think valuations is a key one here, especially around the remortgages and the amount of affordability that you're looking for. But again, I think it just comes back to having open communication. I think lenders do want to lend because they're in that space of lending. They don't lend, they don't make a profit. But again, they want to lend responsibly.
The importance of checking your credit score, which you can get now on a monthly basis, where you can log in for like £7-8 a month. There's a few different companies out there.
Yeah.
But they had previously an issue of, one of them was a water bill, where they wasn't aware there was an issue with the direct debit when it got set up and it got missed.
Yeah.
And that's come up now. They've applied for an application that's affected the lender they've gone with. Mm-hmm. Is there any advice you can give to someone on that? And would you recommend to maybe subscribe to something like that just to make sure, and how much impact could that have on a lender lending?
Yes. So as you quite rightly touched on, sometimes you're unaware of what your credit score or credit picture looks like because you've never downloaded your credit report. And some don't need to, because you've got everything on direct debit, you've got enough surplus income in your account, you think it's all taken care of. But I think what we find is a lot of clients go wrong when they own buy-to-let properties and they've got utility bills for some of their properties that they currently own in the background. Sometimes the letters or the bills don't get to the landlord. That then becomes a red letter, then it becomes a CCJ in the background, and the landlord is not aware of that. So what I always say to our clients is everyone should have some sort of credit scoring update provided to them on a monthly basis. As you quite rightly said, it's usually a couple of coffees a month, 7, 8, 10 quid on a subscription basis. My favorite one is checkmyfile.com. And the reason why that is because they use 3 different credit agencies and they pull in data from the 3, Equifax, Experian and TransUnion, who are 99% of the time, those are the 3 agencies that lenders use to collect data and refer to. So I think the key here is subscribe to a credit agency, keep on top of your credit score. And more importantly, it's not just about the score. Even if you've got 999, it doesn't matter really. It's the underlying data of around defaults, late payments, CCJ, CFAS, anything untoward and adverse, it will cause a detrimental effect. It could delay an application, or it could mean the lender has no appetite for that type of credit adverse. So that means you have to start the whole process again and go to another lender. Now, what we do as a rule of thumb, we ask every single client, are they aware of any adverse or any defaults on their credit rating? If they're unsure, we just say, here's a link, please download it, send it to us. Because what we want to do is we want to work smart. And in the estate agency world, it's all about being swift and being quick and being first. So we've got to be the same as well. So we ask the client, provide the report, we'll scan it through and make sure that the lender that we're pairing the borrower with suits and they match and they understand each other's criteria and they all meet. So yes, I would certainly agree to subscribing to a credit reference agency, keep on top of your credit scoring and plan ahead. So if you are a first-time buyer watching this, these are one of the key drivers I always say, download your credit report, speak to a mortgage brokerage, understand the affordability, understand the actual process as well. People think, it can be done overnight. In our business, I wish it can be done overnight, but lenders are busy, mortgage brokerages are busy, and it does take time for things to, turn around and so on and so on. We'll obviously do our best to meet the strict deadlines, but you've got to work with us and you've got to help yourself before we can help you.
So top tip, make sure you check your credit score. For the sake of £10, it's a no-brainer basically.
100%.
It's a waste of everyone's time if not. Could be a few weeks down the line and to find out that it's going to be declined basically. So yeah, definitely get that checked. There's obviously a mixture of people that are PAYE, self-employed.
Yeah.
What's the minimum requirement in order to get lending? Obviously this is more resi than buy-to-let because like you said, it's based upon the rental figure, but what's the difference? Is there a certain amount of accounts they need to have to take out a resi mortgage? Just break it down for us in a bit more detail.
So for those that are looking to either buy a property, move property, or refinance their main residence, let's go with self-employed first. So if you are self-employed, most of the lenders out there require you to be self-employed for 2 years or more. And 2 years or more means that you've got to have 2 years tax returns filed. You can be either a sole trader, you can be a partnership, or you can be a limited company. Now, we ask you the question, if you are self-employed, are you sole trader, are you a limited company, or are you a partnership? We'll then require from the borrowers, the applicants, 2 years tax returns, 2 years tax calculations, and sometimes the accounts if we require them. From an affordability perspective, most lenders will use salary and dividends if you're a limited company. If you're a sole trader, you use your salary and profits within the business, and that's why we need the accounts to work out the numbers. If we move on to the employed roles, so if you work for your local bank or anybody on the high street, you're employed. You will receive a gross basic salary, which lenders will use 100% to work out the affordability. Beyond the gross basic salary, you may receive a bonus, shift allowance, car allowance, overtime, and anything else in between. Some lenders will accept 100% of the entire package. Some will do 50% of overtime. Some will do 75% of commission. There's different ways they'll cut it up and dice it up. So what our job is to do is find the right lender with the borrower. Now, if you are self-employed, some lenders will accept you being self-employed just for 1 year, as long as you've got 1 year's tax returns filed. If you've gone from an employed role to a self-employed role, so say you are a pharmacist, you were employed, but then you decided to go self-employed within the same role, so you're still a pharmacist, lenders can take a view on it because nothing's changed theoretically. You've gone from the same role to another role, but you've just gone self-employed. So there's ways that they'll take views on it. If you are employed, you don't necessarily, there's a lot of myths. You need to be employed for 12 months, 18 months. You can be employed for less than a month and you can still get a mortgage. So as long as you've got to talk to us, you've got to work with us, you've got to answer our questions. And this is the part of the process we go through to build a picture with our borrowers. So if you are employed and you just started a new job, some lenders accept 1 month's pay slip with a contract of employment. There's different rules for different lenders, depending on where you are in that journey. But again, that's the questions that we would ask. In terms of the affordability, it's anything between 4.5 and 7 times income. Now, there are various lenders out there doing up to 7 times income, but it doesn't necessarily mean everyone can get 7 times because you've got to ensure that you tick the other boxes. So, as a worst case, it's 4.5. As best case, it's 7 times. It could be anything in between. But if you've got a load of debt in the background, you've got a Ferrari on £2,000 a month, you've got this, you've got that, and you've got that. That will then reduce your affordability accordingly. So these are the part of the questions that we go through, and then we will set out exactly how much you'll be able to borrow, as long as nothing else comes out of the can of worms.
So case by case scenario, depend on the circumstance, will depend on the lender that you use, which is why your expertise will come in basically.
100%. You must use an independent broker in today's world.
Perfect. And 7 times.
Yeah, I saw your eyes brighten up there, yes. And it is true. And it's not just to, it's not a to dangle the carrot or anything like that. It is genuinely up to 7 times lenders are offering at the moment. So as I say, get in touch with us. If you don't get in touch, you will never know. But you've got to keep your finger on the pulse, and from a finance perspective, that's what we do. We're in contact with the client banks and lenders every single day of the week. So if we don't keep our fingers on the pulse, how are we going to help our clients get onto the ladder or buy further investment properties as well? So there's lots of ways of acquiring properties. There's lots of ways of raising the funds, but you've just got to remain, commercially minded and speak to the right people. Because if you haven't got the right agents on board, the right brokers on board, the right accountants on board, you will fail.
Which is why the power team is important.
100% power team.
So if you've got any questions regarding anything that's discussed in this video, feel free to reach out to myself or Akhil. I'll include all of our details in the description. Now, before we leave this video now, Akhil, 2 things. First one is, what's the top piece of advice you can give an investor looking to invest in a property for the first time, first of all?
Okay. So, first-time landlord, I would say keep it simple. I know everyone's after those big ticket deals, massive cash flows and everything alike. If you are a first-time landlord, be conscious of your own time first, your own experience and your own education. I would say keep it safe on the first deal, get your feet a bit wet, but build that team around you, get the info, soak up as much information as you can. As long as that property is washing its own face, i.e. it's managing its mortgage payments, managing the voids, managing the maintenance costs, it's a good investment, because property is always a long game. And if you look at property prices over the last 2, 3, 4 decades, it's only gone one way, which is north. So that's great. Yes, it might not be getting you £1,000 a month or £2,000 a month like HMOs do in some instances. Just be conscious, you've got an investment property, it's cash flowing well, it's washing its own face, it's a good deal.
Perfect. And you don't know I'm going to ask you about this, but last month we had an investors conference.
Yes.
Where there was many first-time landlords, big-time investors that was there, lots of banks talking about bridging, lending.
Yeah.
We was also a guest speaking on that show.
Yes.
But just to talk about the next event, we spoke about it's going to be every quarter, is that right?
Yes.
And for those that haven't seen it, do you want to just share a bit of information of what that event covered and why it'd benefit anyone that's looking to maybe get onto the market for the first time, or if they're already an experienced landlord, why it could benefit them?
No, thank you. So last week we hosted an event called EPIC, which stands for Education Property Investors Conference. And what we wanted to do was bring like-minded people into a room with the benefit of hearing from banks, lenders, agents, will writing planners and mortgage brokerage in our mortgage broker. So what we did was we had a room of about 70 people that were of various experiences, from first-time buyers to first-time landlords to large portfolio residential owners to large commercial portfolio commercial landlords as well. So what we had was a bunch of banks providing information on buy-to-lets, the USPs, the current trends. We had a bunch of bridging lenders that provided information about what's the uses of bridging, what's the costs, what the benefits are, what the USPs look like. We had Avocado Property as well, providing an intake on the buy-to-let space in the estate agency model on sales and lettings. And then we had a Q&A panel. So you're quite right, we're going to be hosting these every quarter, and the last one was done at the Crown Plaza Hotel in Gerrards Cross. We've penciled in a new date for September the 8th. So Thursday, September the 8th, around 10 a.m. till about 2 p.m. So more news to follow. So if anybody wants to join us on all our social media handles, just at our mortgage broker, OUR mortgage broker, and keep subscribed or like, whatever they call it nowadays, and we'll keep you posted on our next event is. But the purpose of that event is networking with like-minded people, getting real-time information from banks, from reputable banks, reputable lenders, because ultimately they're the guys that are going to write that check. And then we'll have property professionals as well. So we've got on the cards, we're going to have a conveyancer on the cards, an accountant on the cards, and a couple of others as well. So it's all about having that power team all under one roof to answer your questions, for sure.
Perfect, thank you. So we'll end it on that note. Check out our mortgage broker if you'd like more information on that, or reach out to us. We'll have more information nearer to the time once it's all confirmed. But as he's mentioned, we're looking September time. But thank you very much. We hope you found this video useful. One thing that was mentioned was about bridging. You're probably sitting there thinking, what is bridging? Well, thankfully, we're about to do or release another video going into more detail about what it is, how it could benefit you, and what the benefits are in general. So keep an eye out for the next video. And like I said, any questions, feel free to reach out. Thanks, Akhil.
You're welcome. Thanks again.